Time to join in for the second guest out there. Fundamental story needs to be addressed, perhaps a little different perspective out there. Joining us to take the discussion forward is Feroze Aziz, Deputy CEO, Anand Rathi Private Wealth. Good morning there. Thank you for taking out the time and speaking to us this morning.
Good morning.
All right, I'm just going to start off by asking your assessment. Overall, there are a number of block deals which typically have taken place, and in most of the block deals, you've seen promoters which are offloading equities. It looks like more of the retail category is perhaps at this point of time buyers in the market. FII trend too has started ebbing off. What do you make out of the current situation? Where do you think the markets are headed at this point of time?
Nikki, see, block deals are a part and parcel of this business. Of course, The frequency at which you hear of them could increase, like you rightly pointed out. But I think each business is very different when it comes to block deals. So they have a very little semblance to what the market has for us. Because the sizes are different, the natures of the business are different. Like Redigair, you were mentioning, the 14% stake of Burman family is a very, very different each story, and that has to be analyzed piecemeal. So that's point one. Point two, I personally think the second point which you made, retails are buyers. Retails generally are buyers through the domestic institutional investors, and if that's the hypothesis, then you're absolutely right, because close to 7,000 odd crores has been pumped in by domestic institutions into cash market alone over the last 15, 17 days of August. That's a large number. On the other hand, FIIs, again, like you rightly pointed out, have not been buyers or sellers. They're just about 500 crore negative for this full year. Having said which, my hypothesis over the last few years, which I've tested, is that if domestic institutions buy, mid caps and small caps run up. If foreign institutional investors buy, the large caps run up. So you see this divergence in this financial year between small caps and large caps, which proves the hypothesis that domestic institutional investors are pumping in money, and those are the lead indicators to small caps performance. So that's where I'll stop for your next question, Nikki.
Sure. Speaking of a little more theme out there, perhaps we could address in railways. Do you think there is more steam left for the entire sector? At least the government seems to be ensuring that, given that yesterday there was a slew of approvals which have come in with 7 multi-tracking projects to an extent of around 32,500 odd crore. How do you see that segment? And within the segment, are there any stocks that you would recommend at this point of time?
See, I think when you look at themes, it's very important to analyze the kind of valuations which those themes command. So I personally think a lot of growth has already been done by financial services. For example, in Nifty, 36% of the weight comes from financial services. That's a large weight. About 10 years back, that weight was 29%. And that has contributed about 4.5% on Nifty movement this financial year. Coming back to the point of railways, I think the valuation there is reasonably attractive. And the defensive nature at these levels of the market, when the markets are a little indecisive for the full 1 month, July 20th last month, Nifty touched about 19,979, and from there on, it's tested the lower levels, and buying is also there at the lower levels. So coming back to your point, I would say railways definitely I would, as a theme, play out as a fund manager, but not as a retail investor. I think it's very important to know when to get out. So I would rather look at funds which have a larger exposure to this specific sector because of the valuation being very, very reasonable. And I think there's a lot of headroom over the next few years for value to play out.
Sure. Let's also talk about the entire financial space. The outlook on banks essentially may have turned a little cautious of late, but there seems to be enough takers for the NBFC story overall. At NBFC, perhaps at this point of time, are outpacing banks in terms of the disbursement growth. What do you make out of it? Do you also hold the same assessment?
See, I think if you have to assess the financial services, inflation becomes a very, very important variable, which is a lead indicator to interest rates. If you look at the spike in inflation over the last number, which has come above 7%, which is a surprise number. Largely, if you break down that inflation into smaller constituents, you will realize that vegetable inflation has contributed significantly to this spike. And I personally feel that it's transitory in nature. If not, if I'm wrong, then there could be a rate hike from an interest rate standpoint. So I think that will bring down the credit offtake, which NBFCs are running on the back of. So the peaking out the inflation, interest rates is the story which will decide which directions these NBFC counters would go. But the credit offtake will definitely reduce if we are not already at the peak of the interest rate cycle.
All right. So, are you also a firm believer of NBFC over banks? How would you look at it?
See, what happens is banks have a reasonable, simpler business model to analyze, but NBFCs have very, very different strategies. Like an NBFC, a systematically important NBFC as per RBI, will have a large, diverse business nature. So I personally think each NBFC has a very different NIM aspiration and a business strategy and the delinquency rates. So, but having said which, I would say that there's more headroom for somebody to analyze and cherry pick in the NBFC space than in the bank space currently.
Also, I'd like to chat about GQG, and the Adani group of company stocks. They've, of course, been in traction for the entire week. A flurry of news flow out there. Some of them, of course, is negative. And today, we've seen some amount of finally optimism coming in with another vote of confidence for the group from the GQG partners. What do you make out of it?
See, Nikki, I would not want to specifically comment on the group and its strategy, but I personally think that, like you said, finally there is some degree of optimism. Having said which, of course, the news flow is going to be very large. If you look at one variable which we very consciously track is the ratio of the volume to the market cap, which is a great lead indicator whether this move has to be taken seriously or not. If there's a market cap of 100 rupees, for example, for a company and the volume has been very, very small, then I would not take the up move or the down move as seriously because that's not a large expression of majority shareholders or prospective shareholders.
Right. Overall, are you like a bull on the Indian equity markets right now? Of course, we've been playing out the entire narrative of a structural bull run in place and perhaps, sessions of correction out there, which perhaps serve as a buy on dips kind of opportunity for long-term investors. But do you think the near-term trend at this point of time, given the news flow across the globe and the fears around the rate hikes, would probably weigh in more than anticipated? Your assessment?
Like you see, I'll have to fundamentally express my thought process in this. See, English words hide more than they show, like a bull run, a bear run. A bull run 10 years back had a different definition than it is today, but it's still called a bull run. So since India has lost the base effect, 15 years back, the base effect was in our favor. We were a small economy. We were a small capital market. Today, we are a very large capital market with the largest number of listed stocks, about 4,200 odd in BSE and about 2,000 odd in NSE. So coming to the point, yes, I personally think there is a structural bull run possible. Having said which, the disclaimer is the definition of a bull run means, in the current context, median plus returns of 3 to 4%. A median Nifty return, median is a statistical measure of center of a data point, which is 11 is the median return of Nifty. The mean return of Nifty is 14. I would say that a bull run can be classified as a bull run in the current context with the size of the economy and the capital markets which sit in, is 3 to 5% more than the median is certainly possible over the next 5 years. One more disclaimer as I like to give is that equity as a nature of this beast is that it will show you 15% corrections from peak to trough every single financial year. And that's what it has done for the last 23 years. If you're not prepared to see that peak to trough, then I think you will not be able to benefit from the bull run as I defined as 4 to 5% more than the median return of 50.
What are you currently bullish on within the space which you think still is a value buy after the recent round of perhaps a bit of profit booking that we've witnessed?
So I would certainly say consumer cyclicals have a large role to play. Of course, their weight is not as much. Their weight is about 7% in Nifty. But I think energy and consumer cyclicals will definitely be one of the themes which I generally very microscopically look at when we pick funds for that matter.
All right. And within the IPO space, are you liking anything? Something like a Pyramid Technoplast, perhaps a little small IPO out there to an extent of 150, but Aeroflex is the one where Kacholia is holding in perhaps 2.5% kind of an equity. What do you make out of it? Are you looking at these two?
Nikki, I would not be qualified to comment because I personally think a business goes through a transition, and I generally don't like IPOs because there's no data to analyze from a demand-supply standpoint, and listing gates don't attract me as an investor.
All right, then we're just going to leave it at that. Thank you so much for taking out the time and speaking to us.
Thank you, Nikki.